It's Arjun. This week, we turn back to our favorite topic, and that is profitability and the goal of generating superior long-term stock price performance. I know we spent a lot of time talking about return on capital employed, cash on cash return, CROCI, as well as free cash flow. This week, what I want to get into is the potential for long-term stock buybacks to add to per share growth and to help generate long-term stock price outperformance. And especially for companies that are not blessed with robust organic growth, can you, through good execution, some amount of inorganic growth, M&A, plus free cash flow, good CROCI, good return on capital, but with stock buybacks, generate the kind of per share metrics that can lead to stock price outperformance? And the example I'm going to go through today is Murphy USA, which I think most of you will know is the downstream spinoff from Murphy Oil, the parent. I want to say it was about probably a little more than 10 years ago. Maybe it was 2011, 2012. And it's been a massive outperformer. No one thinks of the retail convenience store business as being massive organic growth. It's a very mature business. Through good execution, through some of the stuff they've done in terms of attracting customers, but through some M&A, but with really an outstanding, consistent, but meaningful stock buybacks story, they have generated massive outperformance over the last 5 to 7 years. We see some of those elements in the US big three downstream companies, what people would have historically called the refiners. Definitely exists in Murphy USA. And the question is, for especially some of the E&Ps and majors, is there an opportunity to emulate some of this kind of model? First point I'd make is, I think the focus on corporate level returns, ROCE, CROCI, free cash flow, it has finally gained primacy. It's an awesome development for the sector. Kind of always been there for the majors. I think the downstream guys were next. It's great to see more of the E&Ps and midstream guys embrace this as well. Corporate level returns, there's no change to how critically important that is, and it will remain so. I think when you look at some of the leading S&P 500 companies that dominate the stock market today, they all have very good corporate profitability, but they also have growth. And in most of their cases, it is organic growth, and that drives the exceptional stock price performance. Now, for traditional energy, advantaged organic growth is a rarity. You see it in a company like Hess, which participated in a massive low-cost oil resource discovery offshore Guyana. Phenomenal volume growth, very good returns because it's at the low end of the cost curve. People understandably have been excited about it. It's now part of an M&A transaction, but that's a rarity in energy. I think the question is, how do you get to a better growth to go with your returns when the organic option isn't there? And that's where, again, I'm going to go through the Murphy USA example, but where you have good execution, you have good cash on cash returns, good free cash flow, supplemented by M&A. And we're, of course, seeing that via the major consolidation wave. How can you marry that with, I'm going to call it, a long-term stock buyback program that really helps drive that per share accretion? It's one example. We're not saying this is the be-all and end-all and the only strategy anyone should pursue, but we are observing how successful it's been with Murphy USA, and it probably does provide a little bit of a roadmap for some of the companies out there. I want to be clear. We are not talking about the short-term, one-off, often reactionary, pro-cyclical stock buybacks that historically plague most cyclical sectors, including the traditional energy sector. We are not talking about that. Sometimes you have an upcycle, cash builds up, and frankly, it can be the sell-side analysts, it can be the buy-side analysts, sometimes it can be activists who say, give us back the cash via stock buybacks. That is not what we are referring to. We are not talking about the pro-cyclical buybacks that frankly have, I think, been value destructive or at least not value helpful and have plagued this sector. So it's probably not a best practice to show such a heavy numbers table, but I didn't quite know how to do it. And I would encourage everyone, if you want to take a moment to pause this video and take a look at this slide, I really do love these numbers. And let me start with Murphy USA, which is the example we're highlighting today. Since year-end 2016 through 2023, they have retired 45%. 45%, you can see the number right here, of their shares. Their EBITDA is actually up 156% in 2023 versus a 3-year average of 17 to 19, trying to dampen the cyclicality a little bit. Again, this is a mature business. There is not a ton by way of volume growth. They did an acquisition a few years ago. That clearly has been accretive. They've done some good things from an execution standpoint to their base business, plus 156% EBITDA. Look at their return metrics. It's what makes this all possible. 21% long-term ROCE over the last 7 years, 22% near-term in 2023. The CROCI numbers 18 and 18 long-term and near-term. And the stock price, total shareholder return, plus 506%. It has crushed the S&P 500, which is up 169%, including dividends. And of course, it's done better than the XLE by a long shot. A shout out to the big three downstream companies in the US. They've also, not quite Murphy USA-like, but they've reduced their shares by 20% between 2023 and 2016. EBITDA is up 130% nearly. Now, a little bit of that more is it was a really good year margin-wise, so you might want to back that off a little bit, but there've been projects, there's been some in M&A, and you've had pretty good EBITDA improvement. The long-term ROC is solid, but the near term has been exceptional. What I think is more exciting for the I keep on to say refiners, the downstream companies, is the 13% long-term CROCI and the 16% 2023 CROCI. Mid-teens kind of CROCI is going to be the type of cash generation, especially when you have a long life asset base, that can allow for more meaningful and continuous stock buybacks. Still a little bit below where Murphy USA is, but again, I'm going to say that's kind of where you're going to need to get to. Now let's look at the majors and these two E&P groups, the oil and gas E&Ps. The majors have at least had some share reduction, but for a group that usually was known for buying back stock, not even as good as the U.S. downstream companies. EBITDA improvement for the majors and E&Ps up 50%, and oil was, low 50s in that 2017 to 19 period. It was $75-ish in 2023. That's going to be a lot of that EBITDA improvement. The return metrics you can see here, the more recent ROC numbers are competitive. The CROCI numbers at a sector level, frankly, you're going to want to have teens type numbers. Now, I'm showing these broad sector averages, super majors, E&Ps, even the big three downstream guys for that matter. This is really about what individual companies should do. Here at Super-Spiked, I don't like really going through this is what this company should do or that company. I'm using Murphy USA as a legacy example of what has gone right as kind of a roadmap. What you'd really want to do is go through these groups within the super majors, within the oily and gas E&Ps, who has mid-teens CROCI, cash on cash returns, who has perhaps a defined asset base with not a lot of organic growth. And we can debate whether they've done M&A or should do M&A or they haven't. I think for those types of companies, again, it all starts with profitability. You have the chance to implement potentially the kind of long-term stock buyback program that generally you've not seen. You can see here that the shares are up for the E&P companies. Now, a bunch of them done M&A. I don't think the sector average is actually the right way to look at that number. Clearly, when you buy another company, your shares go up, but their shares go away. Someone can tell me whether I should adjust for the shares that have gone away or not. Again, I would say what I would like to do or what I plan to do and what we do at Veriten is really go through and look at the individual companies and say, for who has the type of strategy that should implement the kind of Murphy USA style type buybacks. And again, look at this bottom picture. It's just so beautiful. It's their share count going from 46 million shares to, I can't remember the number, was like 22 or 23 million in the most recent years. I mean, that's a, 8-9% CAGR reduction in their share count. Awesome example. It's just one example. It's not the only example, but it's certainly one that the proof is in the TSR, which is simply stunning. Now, I do want to be clear about stock buybacks. There are some lessons from past examples that we need to be mindful of. We are not talking about, I've said it before, it bears repeating, the kind of pro-cyclical, one-off, reactionary, you built up cash or an activist there, is what have you, type stock buybacks. That is not what we're talking about. We're talking about long-term, consistent over 5, 7, 8, 10 years of type of meaningful buyback CAGR. Strong profitability, it's absolutely prerequisite. It starts with good cash-on-cash returns, good return on capital employed. It starts with the kind of asset base that can generate free cash flow and at least allow production to stay flat, most likely supplemented with some amount of inorganic acquisitions and M&A. It is from your cash flows. It is from the outcome of your good investment decisions that you're able to generate dividends and stock buyback potential. It's not the other way around. You don't create a good company by suddenly buying back stock. you have to have the type of asset base and the type of execution and the type of good M&A track record that inherently allows for it. It starts and ends with good corporate profitability. Not everyone has organic growth, and that is going to be especially true in a mature traditional. So I think, as you know, we think, I should say at Veriten, that there is no decade, let alone year, where anyone can declare where oil or natural gas, or for that matter, coal, demand is going to peak. But we're still talking 1.5%, 2% kind of growth rates, maybe as little as 0.5% kind of growth rate, depending on the year. It is not a robust growth sector. And the opportunities for meaningful organic growth are simply going to be few and far between. That does mean having an M&A skill set, doing things organically and executing well. I think you combine that inorganic opportunity with free cash generation, cash on cash returns, and stock buybacks, and you have a chance to compete for stock market dollars versus broader sectors. Murphy USA is just one example of a company that I think so far has done it really, really right. And I think it's incumbent upon all of us that spend a lot of time looking at traditional energy. What are the other examples out there in the industrial sector, the material sector? Could be any range of companies where there's some cyclicality, more for some, less for others, but where you're in a more mature industry, but you generate good cash flows and you do good things with it. I think we can't just be looking within energy and making oil price calls. I think corporate strategy is something where we should be looking more broadly. And while competing with hot AI or software may not be practical, the market's going to want some element of how can you grow with good returns. And again, it can be through the stock buyback. So I'd like to end this video on a personal note. This past weekend, our youngest child graduated high school, third child of 3, and we are done. We are empty nesters. And now, you know what? I don't think there's really a chance my kids are still watching this video. I think a nerdy stock buyback discussion is not going to compete with TikTok or so forth. Possible my wife is still watching. But listen, in all seriousness, kids, raising you at home has been awesome. Best decision I've ever made, and I've said it before in previous videos, was retiring from Goldman as a partner in 2014 and getting to see my oldest through middle school, high school, and her first 3 years at college. She also graduated this spring. My son, all in middle, high school, and a couple years at college. And for my baby, she was still in elementary school, last couple of years there, all in middle, all of high school. If you have the opportunity to do that, it is an absolute no-brainer. Yes, I did some board and advisory work. That was great. I have now unretired because they're all leaving, but it really has been an awesome blessing. And kiddies, if you choose to somehow watch this, you are all welcome to come back home. But I have to say, we're pretty excited that at least the number of pickups and drop-offs are going to hopefully go down pretty meaningfully here. Anyway, that's it. And thank you so much.